6 money rules that work in any economy. You ever check your bank account and feel like the math just doesn't make sense? Like you worked all week. You didn't do anything crazy. Maybe a few takeout orders, a couple Amazon packages, groceries, gas, and somehow your account is $700 lighter than you expected. So you start doing that mental replay. Wait, where did it actually go? And here's the weird part. Even people making $40,000 a year feel this way, but so do people making $120,000 a year. Because the truth is, most people aren't struggling because of the economy. They're struggling because no one ever taught them the basic rules of money. And the problem with money rules is that most of them only work when the economy is good. Invest aggressively when stocks are rising. Buy real estate when interest rates are low. Start a business when consumer spending is strong. But what happens when inflation spikes, interest rates climb, markets crash, or layoffs start happening? Suddenly, all those strategies stop working. So today, I want to talk about something different. 6 money rules that work in any economy. Recession, inflation, boom times, stock market crashes. These rules still work. And honestly, they might be the difference between constantly feeling stressed about money and actually feeling like you're moving forward. My name is Sem, and I spend way too much time thinking about how people actually build financial stability in unpredictable economies. If you're someone who works hard but still feels like money disappears faster than it should, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because the goal here isn't just to talk about money, it's to understand how money actually behaves in the real world. And once you understand that, a lot of financial decisions suddenly become way easier. So let's start with rule number 1. And honestly, this is where most people go wrong. Rule number 1, your lifestyle should grow slower than your income. Look, this sounds obvious, but almost nobody actually does it. Here's the thing. When people get a raise, their brain immediately starts upgrading their life. New apartment, better car, more restaurants, better vacations. And this happens so automatically that we don't even notice it. Economists actually have a name for this: lifestyle inflation. According to research from the U.S. Bureau of Economic Analysis, consumer spending rises almost perfectly in line with income increases, which means most people don't keep their raises, they spend them. Now here's what most people don't realize. A $10,000 raise doesn't change your life if your expenses increase by $9,500. But if your lifestyle only increases by $3,000, that same raise creates $7,000 in extra financial power every year. And over time, that difference becomes massive. Let me show you the math. Imagine 2 people. Both start making $60,000 per year. Every year, they get small raises. After 10 years, they're both earning $85,000. But person A increased their lifestyle every time they got a raise, so they're still living paycheck to paycheck. Person B only increased their lifestyle by half of every raise. That difference might create $10,000 to $15,000 per year in savings capacity. Over a decade, that's easily $100,000 plus in invested money. Same income, completely different financial life. And the reason this rule works in any economy is because it has nothing to do with the market. It has everything to do with human behavior. Rule number 2, always keep a stress buffer. Now this is where things get really interesting. Most financial advice says you need 3 to 6 months of expenses saved. And look, that's not bad advice, but the real purpose of savings isn't what most people think. It's not just about emergencies, it's about decision-making power. Here's what I mean. According to a Federal Reserve survey, about 37% of Americans cannot cover a $400 emergency without borrowing money, which means a huge portion of people are living in constant financial fragility. And when you're financially fragile, you make different decisions. You stay in jobs you hate. You tolerate bad work environments. You delay opportunities because you can't afford risk. But when you have even $5,000 to $10,000 saved, something psychological changes. You breathe differently. You negotiate differently. You say no more often. And that's powerful. Think of it like oxygen in a plane cabin. You don't notice it when it's there, but when it's gone, everything becomes stressful. So rule number 2 is simple. Build a stress buffer, not just for emergencies, but for freedom. Rule number 3, invest consistently, not emotionally. Now let's talk about investing, because this is where human psychology absolutely destroys people. Look, markets go up, markets go down. That's normal, but people don't behave normally. When the market crashes, people panic. When markets are booming, people pile in, which means the average investor ends up doing something backwards, buying high and selling low. According to Dalbar's long-term investor study, the average investor earns significantly lower returns than the S&P 500 because of emotional timing decisions. For example, between 1992 and 2022, the S&P 500 averaged about 9 to 10% annually, but the average investor earned closer to 6%. That gap might not sound huge, but this is where the math gets scary. Let's say you invest $500 per month. At 10% returns, after 30 years, you'd have about $1.13 million. At 6% returns, about $500,000. Same contributions, half the result. All because of emotional decisions. So rule number 3 is simple. Invest consistently, not emotionally. Rule number 4. The real wealth builder is time. Now you might be thinking, okay, but I don't have thousands to invest. And that's fair. But here's what most people don't realize. Wealth isn't built with huge investments. It's built with time. This is where compound interest becomes almost unbelievable. Let's take 2 people again. Person A invests $400 per month starting at age 22. They stop investing at age 32. Total invested, $48,000. Person B waits until age 32, then invests $400 per month until age 65. Total invested, $158,000. Guess who ends up with more money? Person A, because their money had an extra decade to compound. Assuming a 9% return, Person A might end up with $700,000 plus. Person B, around $650,000. Even though they invested 3 times more money. This is why starting early is so powerful. Time does the heavy lifting. Rule number 5. Income matters more than frugality. Now this one might be controversial because the internet loves extreme frugality. Cut coffee, cancel Netflix, stop eating out. And look, controlling spending matters, but the reality is you can only cut expenses so far. Income has no ceiling. Let's do a quick example. If someone earning $50,000 cuts $300 per month in spending, that's good. But if they increase their income to $65,000, they might gain $900 after tax. That's 3 times more financial power. According to U.S. Census data, the biggest driver of long-term financial mobility is income growth over time, not extreme cost cutting. Which means learning valuable skills, negotiating salary, changing industries, starting side businesses. These things matter more than skipping lattes. Rule number 6. Most financial problems are psychological. And this is the rule nobody talks about enough. Money problems are rarely just math problems. They're behavioral problems. Impulse spending, fear during market crashes, lifestyle inflation, avoiding budgets. All psychological. Behavioral economists like Daniel Kahneman and Richard Thaler have shown that humans are extremely irrational with money. We prioritize short-term comfort over long-term stability. Our brain evolved to survive the next few days, not optimize retirement accounts, which means successful money management often looks boring. Automatic investing, simple budgets, slow wealth building. Not flashy, but incredibly effective. Bringing it all together. So let's quickly recap the 6 rules. Let your lifestyle grow slower than your income. Build a financial stress buffer. Invest consistently, not emotionally. Start early because time multiplies money. Focus on increasing income, not just cutting expenses. Understand that money is mostly psychological. And here's the thing, none of these rules depend on the economy. They work in recessions, they work in inflation, they work during market booms, because they're based on human behavior and mathematical reality, not predictions. Final thoughts. Look, no one gets everything right with money. Everyone overspends sometimes, everyone makes bad investments, everyone learns things the hard way. But the people who eventually build stability usually do one thing differently. They follow simple rules consistently. Not perfectly, just consistently. And over time, those small decisions start stacking. Savings grow, investments compound.
If this helped you see money differently, subscribe for more deep dives into the psychology and math of building real wealth. I'll see you in the next one.